Hello, everybody, and welcome to the monthly market memo for the end of July 2024. I'm Kay Seichenberger, the Chief Investment Officer with Retire Path Advisors. And today's monthly market memo, we have quite a bit to discuss. So let's go ahead and get started, shall we? Well, we've seen a lot of good news so far this month of July as far as the macroeconomic front goes, and that continues with inflation. Inflation has moved lower year over year since it's peaked in June of 2022 at about 9%. Right now, we are running at just 3% year over year. And that is getting very close to the Federal Reserve's desired level at 2%. And actually, they look at a different type of inflation called the PCE inflation, which is running around the mid 2% range. So the fight for inflation to get it down to level is nearing to where they'd like it to be. And actually, the month of June's CPI, Consumer Price Index, came in at a negative 0.1%. So we actually saw a little bit of deflation in mostly the energy areas for the month of June. Additionally, though, we've seen some negative news, and that is on the unemployment front. It's really moved up from the mid 3% range to now over 4%, which actually is a little bit higher than what the Federal Reserve would want it to be. And with both of these numbers, we do feel there is a strong case to be made for the Federal Reserve to finally start cutting rates in September. And it's something that has been boosting markets here lately, especially the bond market, as we've seen really good bond market returns for the month of July, up around 2% or so, which has definitely outpaced cash. So good news on the inflation front. Also good news on Q2 GDP, which we got the first numbers out here a few days ago. And Q2 GDP grew at an annualized rate of just under 3%, which is really right at its long-term pre-COVID trend at around 2 to 3%. So that's been the good news. It's actually doubled Q1 trend growth rate at 1.4%. This, as always, has been led by you and I and everybody else, the consumer of this great economy, which continues to just move forward and onto the future to keep our growth growing solid. Also, we've started to be in the midst of Q2 earnings. Corporate earnings come out around this time every quarter, and we start to digest to see what corporations are facing as far as headwinds and what they're seeing as far as tailwinds. And really, it's been a mixed bag. You've seen stocks really been a little bit more volatile. We've seen most corporations beat analyst expectations, which is good, but the magnitude they're beating those expectations by has been less than average, which has caused a little bit of volatility here in stocks. The good news is we've seen growth. We will continue to see growth, we expect, as double-digit growth is expected for this year, 2024, 2025, 2026. So again, that is why we own, as an owner of corporate stocks, is to participate in these strong earnings, and earnings growth has been good and is expected to be good for the remaining few years to come. Additionally, let's talk a little bit outside of large cap stocks, which dominate earnings news, and jump into small cap stocks. As I mentioned, July has been a little bit of an up and down month for the large cap companies, right around positive 1% return, which is still very good. But we've actually seen a much more what we call expanding breadth in the stock market. And we've seen small and mid cap companies, which really lagged up until July, start to beat large cap companies. They're up between 7 and 8% for the month of July alone. So they've really caught up some of the pace that they've lagged to begin the year, which has been good to see. We believe this bull market is still very strong, and the fact that we're starting to see participation of the smaller mid-cap companies come to fruition is a good thing to continue this bull market. Now, why have they been moving higher? Really, it is enthusiasm, going back to my first point on Federal Reserve cutting rates. The small cap companies, mid cap companies tend to have a lot more variable debt, meaning as rates go up, their debt goes up. They also tend to benefit from lower borrowing costs. Obviously, both of these would come down if the Federal Reserve would cut interest rates. And that's why you've seen a really invigorated stock market moves in the small and mid cap companies with the anticipation that the Fed may cut rates. They probably won't cut rates here in July, but at the September meeting, it is really expected they will cut rates. Now, let's switch gears to politics. Obviously, we've had a lot of political news. We had a very early debate. We've had President Biden drop out amongst the assassination attempt on President Trump. But we always want to take a step back and we just remind people to stick to your long-term plan and try to tune out that political noise. The chart I wanted to show you today really shows the stock market tends to always move higher over time, of course, over the long term, no matter who's in office, red or blue, Republican or Democrat. There's really only been two common era presidents where the stock market has moved lower in their term. Richard Nixon and President George W. Bush II. Those were the two other only presidents. So we just want to take a step back and remind people that the markets are much larger than just politics alone and one man alone. Corporate earnings matter, inflation matters, interest rates matter, and also Federal Reserve policy and fiscal policy matter a lot more than one person coming into office. So that is it for this month. Thank you again for your trust. We approach the management of your complete financial landscape very seriously. As a trusted steward, advocate, and confidant, we are completely committed to you. Please stay connected to us. Find us on the website at retirepathodvisors.com. Email us, email your advisor, of course, with any questions. And I'm always available to speak to you as well if anything comes up. Thanks again, and I hope you're having a great summer. Thank you.